So you've built a profitable business. The money is coming in and you're paying yourself what you need. And there's cash building up inside of your corporation every day. Retained earnings that needs somewhere to go. This is actually one of the most common questions to have as a business owner, and it's one of the most commonly mishandled. The thing I see the most often when I sit down with a new incorporated client or business owner is retained earnings sitting in a corporate savings account or cashable GIC. In this case, you're probably earning, depending on where you are, between 0.5 and 2% before tax. That sounds okay until you factor in how investment income is taxed within a corporation. Investment income inside a Canadian-controlled private corporation, or CCPC, is taxed at roughly 50% in Ontario. Interest income is the worst offender. The combined rate here approaches the top personal marginal rates. So if you did wind up finding a GIC and it does pay you a good rate of, let's say, 4%, you're actually earning about 2% after corporate tax. And of course, against inflation, you're likely going backwards. The corporate tax advantage, and there is one, is that you're starting with a larger capital pool to invest because the money that was taxed at the small business rate of 12.2% rather than your personal marginal rate of, let's say, at the top bracket, 53%. That deferral benefit is real and it compounds, but only if the money is actually invested in something that works. My investment philosophy is evidence-based. That means every strategy is grounded in decades of academic research, not just gut feelings or quarterly outlooks from an internal research team. For retained earnings inside a corporation, that means low-cost, globally diversified equity portfolios built for long-term compounding. Portfolios here are designed to capture market returns as efficiently as possible, with the corporate tax situation factored into the asset allocation and asset location decisions. The evidence on this is not subtle. The majority of active fund managers will underperform the index that they're trying to track over any meaningful time period after fees. We don't try to beat the market here, we build portfolios that capture it. There is one number every incorporated owner with retained earnings needs to have on their radar today. $50,000. That's the annual passive investment income threshold above which your small business deduction starts to erode. Here's an example. For every dollar of passive income above $50,000, it reduces your SBD limit by $5. At $150,000 in total passive income, your small business deduction is gone entirely. Your active business income, which is an example in Ontario is taxed at 12.2%, now faces a tax rate of 26.5%. On $50,000 of active income, that's $71,500 in additional corporate tax annually. I'll do a full deep dive on the $50,000 threshold in a separate video because it actually does deserve its own conversation. But if you have retained earnings and you're not tracking this number, you need to start today. Before retained earnings become the priority, personal registered accounts should be looked at. As of 2026, the RRSP limit per year is about $33,810. And of course, this grows tax deferred and the contribution is deductible against your income. Your TFSA, as of 2026, about $7,000 per year, grows completely tax-free and withdrawals do not affect OAS clawback in retirement. So in that case, every dollar that goes into a registered account personally is a dollar that does not count against your corporate passive income threshold. That coordination matters. Retained earnings are also directly connected to your retirement strategy, your HoldCos structure, your IPP eligibility, and your eventual exit from the business. How the money is invested inside your corporation right now affects whether you qualify for the Lifetime Capital Gains Exemption when you sell your business. These are not separate decisions. They're one decision viewed from different angles. I'm Harry Sale, financial advisor at Raymond James in Toronto. I work exclusively with incorporated professionals and business owners and their families across Canada. If you want to understand how your retained earnings should be structured for your specific situation, the link to book a call is in the description.